overall measure of prices paid by consumers, increased 2.3% over the 12 months ending in May, that number up from 1.5% a year ago. Overall, or headline inflation, increased partly because of higher oil prices, which caused a sharp rise in gasoline and other energy prices paid by consumers. Because energy prices move up and down a great deal, we also look at core inflation. Core inflation excludes energy and food prices and generally is a better indicator of future overall inflation. Core inflation was 2.0% for the 12 months ending in May, compared to 1.5% a year ago. We will continue to keep a close eye on inflation with the goal of keeping it near 2%. Looking ahead, my colleagues on the FOMC and I expect that with appropriate monetary policy, the job market will remain strong and inflation will stay near 2% over the next several years. This judgment reflects several factors. First, interest rates and financial conditions more broadly remain favorable to growth. Second, our financial system is much stronger than before the crisis and is in a good position to meet the credit needs of households and businesses. Third, federal tax and spending policies likely will continue to support the expansion. And fourth, the outlook for economic growth abroad remains solid despite greater uncertainties in several parts of the world. What I have just described is what we see as the most likely path for the economy. Of course, economic outcomes that we experience often turn out to be a good deal stronger or weaker than our best forecast. For example, it is difficult to predict the ultimate outcome of current discussions over trade policy, as well as the size and timing of the economic effects of the recent changes in fiscal policy. Overall, we see the risk of the economy unexpectedly weakening as roughly balanced with the possibility of the economy growing faster than we currently anticipate. Over the first half of 2018, the FOMC has continued to gradually reduce monetary policy accommodation. In other words, we've continued to dial back the extra boost that was needed to help the economy recover from the financial crisis and the Great Recession. Specifically, we raised the target range for the federal funds rate by 1/4 percentage point at both our March and June meetings, bringing the target to its current range of 1.75% to 2%. In addition, last October, we started gradually reducing the Fed's holdings of Treasury and mortgage-backed securities, and that process has been running smoothly. Our policies reflect the strong performance of the economy and are intended to help make sure that this trend continues. The payment of interest on balances held by banks in their accounts at the Federal Reserve has played a key role in carrying out these policies, as the current monetary policy report explains. Payment of interest on these balances is our principal tool for keeping the federal funds rate in the FOMC's target range. This tool has made it possible for us to gradually return interest rates to a more normal level without disrupting financial markets and the economy. As I mentioned, after many years of running below our longer-run objective of 2% inflation, inflation has recently moved close to that level. Our challenge will be to keep it there. Many factors affect inflation, some temporary and others longer lasting. So inflation will at times be above 2% and at times below. We say that the 2% objective is symmetric because the FOMC would be concerned if inflation were running persistently above or below our 2% objective. The unemployment rate is low and expected to fall further. Americans who want jobs have a good chance of finding them. Moreover, wages are growing a little faster than they did a few years ago. That said, they are still not rising as fast as in the years before the crisis. One explanation could be that productivity growth has been low in recent years. On a brighter note, moderate wage growth also tells us that the job market is not causing high inflation. With a strong job market, inflation close to our objective, and the risks to the outlook roughly balanced, the FOMC believes that, for now, the best way forward is to keep gradually raising the federal funds rate. We're aware that, on the one hand, raising interest rates too slowly may lead to high inflation or financial market excesses. On the other hand, if we raise rates too rapidly, the economy could weaken and inflation could run persistently below our objective. The committee will continue to weigh a wide range of relevant information when deciding what monetary policy will be appropriate. As always, our actions will depend on the economic outlook, which may and will change as we receive new data. For guideposts on appropriate policy, the FOMC routinely looks at a range of monetary policy rules that recommend a level for the federal funds rate based on the current rates of inflation and unemployment. The July Monetary Policy Report gives an update on monetary policy rules and their role in our policy discussions. I continue to find these rules helpful, although using them requires careful judgment. Thank you, and I will be happy to take your questions.
Thank you for your statement, Chairman Powell. And the first question I have will relate to CCAR. As you know, the Fed recently released the results of the 2018 Comprehensive Capital Analysis and Review, the CCAR stress test. This year, the Fed issued conditional non-objections to certain banks, which you have, as you are aware, some have criticized. What details can you share about the Fed's decision to issue the conditional non-objections while allowing those firms to maintain capital distributions at recent levels?
Thank you, Mr. Chairman. So the CCAR supervisory test is and will remain an important part of our supervisory framework, particularly for the largest and most systemically important firms. And I guess I'd start by saying that this year's test was, by a good margin, the most stringent test yet. Hypothetical losses for 2018 were $85 billion higher than during the 2017 stress test. And the hypothetical decline in the capital ratio was 110 basis points higher this year than last year. So a very significantly severe test. And it will result in a material increase in the effective aggregate capital requirement of the firms subject to the test. So we carefully evaluated the results. We voted on them on June 20th, and the next day the firms received a call from our staff, which informed them of the results and their options. This is the standard operating procedure that we follow every year. There's no negotiation. There's no haggling. The decision has been made the day before by the board, and they're just informed of their options, and they deal with them as they are. Almost all the firms finished above the required post-stress minimums, which is a sign of how well capitalized the industry is. Two firms that did not were required to restrict their distributions to past year's levels. That has always been the penalty for failing to meet the post-stress minimums, and that will require the firms to build capital this year, these two firms. The third firm was required to take certain steps regarding the management and analysis of its counterparty exposures under stress. As for so that was the same exact penalty was paid. We labeled these as conditional non-objects rather than objecting straight out to the plan. And we've done that over a period of years many times, and we thought that it was appropriate here. When we fail a firm, when we actually fail them and what we do is we send the plan back and say that your capital planning process is deficient. Please take this plan back, please fix it and bring it back to us and we'll look at it again. So that sends a signal that we believe that the capital planning processes of the firms are deficient in some serious way. As I mentioned, in a number of cases, we've gone with sort of an intermediate sanction, and we felt that that was appropriate here. One reason for that is the timing of the tax bill, as we've mentioned. And firms plan, of course, well in advance so that they'll have enough capital to pass the tests. This particular bill passed, was signed into law on December 22nd. We use fourth quarter capital levels for the test, so the tax TCJA resulted in a significant decrease in the level of capital these firms have. But of course, they don't benefit from what, in longer term, will be a lower tax effect on their earnings. So I think whereas any analyst would look at that law and say that it's positive for banks and for their ability to earn money, it was strictly a negative in this test. So we looked at that, and among other factors, we decided to use the conditional non-object. And I'll stop there, Mr. Chairman.
All right. I appreciate that explanation. And essentially what I'm hearing you say is that the same, in fact, even a stricter test was applied, and the same standards of review were used in your analysis and in the consequences that were applied.
That's right, and I just would reiterate our commitment to this particular supervisory stress test. It's a very important thing for us, and we'll make sure to keep it stringent.
All right, thank you. Chairman Powell, moving to regulation, the recently enacted Economic Growth Regulatory Relief and Consumer Protection Act received significant bipartisan support, as you know. In addition to several provisions providing regulatory relief to community and mid-sized banks, a key provision of the bill raises the threshold for the application of the enhanced prudential standards from $50 billion to $250 billion. What is the Fed's process for quickly implementing S-2155, including its process for ensuring that the financial companies with total assets between $100 billion and $250 billion promptly receive similar relief to the relief provided for the financial institutions with less than $100 billion in total assets?
So our intention and our practice is going to be to implement the bill as quickly as we possibly can. You probably know, I'm sure you know, we released a statement the Friday of July 4th week laying out our plans to move ahead with some things. And we'll do them as quickly as possible, and we indicated that we will try to move that along very quickly.
All right, thank you. Senator Brown.
Thank you, Mr. Chairman. Mr. Chairman, I have a number of questions. I hope your answers can be brief. I thank you for our phone call the other day. I know you know this in real terms. Wages haven't budged recently. Last week, BLS reported that hours for production and non-supervisory workers are flat, and pay has actually dropped over the past year. Of course, we should focus on real wages rather than nominal wages. By that measure, is the typical worker really better off this year than he or she was a year ago?
Yes. Yes, I would say that the labor market has strengthened. The labor report will show that wages went up 2.7%. That's significantly higher than trend inflation. There is a bit of a bump from gas prices going up, and consumers do pay that, but I would say that overall workers are better off.
I would partially contradict that, say that non-supervisory workers, 4 out of 5 workers, have seen nominal wages go up, but real wages haven't by those same BLS statistics. Let me move to another. You've called stress testing the most successful regulatory innovation of the post-crisis era, but the action, you said that some time ago, the actions the Fed has taken during your tenure undercut that effectiveness. The Fed gave Goldman, Morgan, and State Street passing grades this year, even though they failed to meet capital requirements in CCAR, the first time that's ever happened in CCAR history. The Fed proposes to weaken the leverage constraint in CCAR, reportedly may drop the qualitative portion of the test, wants to give bankers more leeway to influence the Fed's models, and may soon adjust Dodd-Frank stress tests to make them less stressful and less frequent, hence the periodic. Stress tests were adopted in 2009 to provide confidence to the public that the banks could weather economic shocks. How is the public supposed to trust the stress tests when the Fed proposes in all of those ways to weaken them?
We're strongly committed to using stress tests. We really developed the supervisory stress test at the Fed, and as you know, we think it's a very important tool. It was one of the main ways that we used to raise capital, particularly among the largest firms. And we're committed to continuing stress testing as one of the 3 or 4 most important innovations, along with higher capital, higher liquidity, and resolution. It's one of the big 4 pillars for us. The program has to continue to evolve. We want to strengthen it. We want to make it more transparent. We want to improve it over time. And that all of our actions are designed to do that. And I think if you look at the state of the banking system and the fact that this test will require higher capital, then I think you'll see that's consistent with, that our words are consistent with our actions.
Well, I think the message coming out emanating from the business press, and those are not, Democratic liberal newspapers, they are the Wall Street Journal,